Okay, hi all. What I'll do first is I'll just leave the plan for today, the goals for today. We'll just get into the meat of the presentation in a few seconds. So with your permission, we're going to drive straight into teaching today. We're not going to bother with a huge sales pitch. It's not going to be 90% sales pitch and 10% fever pitch at the end. We're just going to talk about trading and in particular how to improve yours. So in this session, we're going to be taking you through the basics of order flow. That's for first timers to order flow, and also a refresher for old hands that have got a bit confused with it and maybe heard so many different opinions and really don't know what to do with it. And we're going to keep it simple and jargon free today. Okay, so what is order flow? Well, order flow is simply the art or the science of using additional information to trade with, and that information being the actual trades executing. And that's also known as tape reading. Now, order flow analysis is also about keeping an eye on resting limit orders, but it's the actual trade executions that you're watching that are the most important and critical thing about reading order flow. And it's really all about cause and effect. So if you think about it, when you look at a price chart, it's showing you the results of trading. It's showing you what has happened. And that is absolutely fine. But as many of you have found, it's just not as predictive as people are promising, which is why a lot of traders spend many years getting nowhere with trading. Now, professional traders think about the markets in terms of cause and effect. Moves in price always have a cause, and the actual resulting move is the effect. So in trading, we want to understand the cause of moves, and we're not going to be doing that by studying the results of the moves, by studying the effect. So it's a bit like if I didn't do my homework because the dog ate it. The effect is no homework, but the cause is leaving my textbook where the dog could get it. So we can anticipate homework completion by how close we leave the textbook to the dog. And that is the absolute truth, sir. So with an understanding of what causes moves in the markets, we have a much better idea of whether a trade will work out or not, allowing us to pass on potential bad trades and scale into good ones. Order flow allows us to improve the price on trades by waiting for the right moment to enter too, to go long when the sellers really have stopped selling, not just because we've hit some support point. Now, order flow isn't just used to get you into the markets either. Analyzing the flow of trade once you're in a position is actually the simplest use of order flow, as it requires you to just be able to read momentum. Then cutting the trade before it hits your stop, getting out of a trade that's on your side because there's no commitment there, that's going to have a huge impact on your bottom line. Now, of course, most traders come to order flow wanting to improve what they've already got. But as you observe order flow, you're also going to see new opportunities, especially in what you consider now to be the middle of moves, places that perhaps now you feel are too late, or perhaps now where you'd consider you've missed the move. Okay, so you'll see new opportunities, and that'll be revealed to you more and more the more you watch the order flow. Now, one of the great things about order flow is it stops you from trading against the market. And my experience, I've met traders. Last year I did a poll that really hit home to me, and we did a poll of traders, and we found traders that have been in this game for 20 years without making any profits. And most of those guys are making one fairly simple mistake. And that big mistake is they're trying to trade against the market. Now, most people don't think they're trying to trade the market, but a lot of people think that trading at support is the sensible way to trade, right? But to hit support, price has to be moving down. So whenever you buy support, you are, by the very nature of that, trading against the market, right? So it doesn't mean that you can't trade support, but if you want to know whether support would hold, then it's order flow that you're going to do to find that out. So what we're going to do now is we're going to go back to basics, and we're going to talk about how price moves, okay? How price moves, right? Not why price moves, okay? So slightly different things. why, or even maybe a better way to think about it is, why doesn't price move all over the place, right? If you're trading like crude oil, why isn't crude oil $60, $67 one minute, and then the next minute crude oil's $80, and the next minute crude oil's $1? I mean, why not? Why not? If somebody puts in a bid for $1, why can't they get filled, right? We know that the markets move in a fairly orderly manner, right? But most traders don't really think about that too much. Most traders don't really think about, why is the market orderly? Why doesn't the price just jump around all over the place? And it's really important to know this, right? So all traders know price goes up and down, but they don't really think too much about how it goes up and down. At Jigsaw, we actually believe this knowledge is essential. So without any complex jargon, in very simple terms, what we're going to do now is we're going to lay that out for you, right? So I want you to listen here. If you've got Facebook open, switch off Facebook. This is really important and really fundamental to understanding any financial market, right? So the first thing we need to understand about markets, there's a lot of people, they talk about markets as auctions, right? So you say, oh, the market's auctioning up, and it sounds really smart, but it just really means the market's moving up. And people talk about market as an auction, but if you've ever been to an auction, you will know, if you've been to a car auction, a lot of us have, you will know the market is absolutely nothing like a car auction, right? So when people are saying the market's like an auction, to me, it's really, really difficult to conceptualize that. Well, it's like an auction. How can prices go in two different directions? Because when I've ever been to a car auction, price only went up, right? So we look at the markets, instead of looking at the markets as an auction, think of them as four-way markets. So in other words, there are four forces at play in the markets that impact the movement and the overall direction. So these forces are buy limit orders. Okay, you all know what a limit order is, right? And that is what we call the weak up force. We've got sell limit orders, which are the weak down force, right? We've also got buy market orders. Okay, that is a strong up force, and we got sell market orders, and that is a strong down force, right? So the first question that probably comes to mind is, where are the stop orders? Well, stop orders are important, but they don't really count as one of these individual forces, because stop orders are basically market orders that get created when something happens. So a stop order is really just an instruction to create a market order. So basically, when you look at stop orders, they're here. So basically what we can see is limit orders are weak and market orders are strong, but they're both forces that impact price movement, right? Now, speculators, and I presume everybody in this room is a speculator, will switch from being one force to another. So to get in and out of the market, you're going to first buy and then sell, or vice versa. And you're participating, obviously, as two different forces at two different times. You might even get in with a market order, but out with a limit order. And over the duration of one position, it's not uncommon to participate as all four forces throughout the management of that trade. Now, you probably don't care at a guess which way the market is going when you make a trade. I don't know any trader that cares if the market's going up or down. They just care about whether they're right, okay? And we're going to presume in this session, right, and this is really important to think, right, whenever you think about trading and you think about the market as this entity that's not the same as you, take a step back and think for a second, how would it affect the market if the market was actually just like me, right? So just like me, I don't care if the market's going up and down. I don't care if crude goes up or down tomorrow, or the S&P goes up and down tomorrow. I just care if I can get on the right side of that, okay? So it's reasonable to presume that most of the people in the markets are exactly the same. So most people in the markets are one of these forces, and we change throughout trades throughout the day, and we generally don't care which side of the market we're on. Now, there are four forces, but there's only two possible trades or two possible interactions in the market. So there's two ways those four forces can work together. So when a buy market order gets traded, it's because it's traded with a sell market order. And we consider, let me just put my pointer on, sorry. Okay, so we consider the trade where a buy market order hits a sell limit order. We consider that to be a buy because the market order is the stronger order, it's the aggressor, right? The other interaction, we call an interaction down, is when a sell market order trades with a buy limit order. Now, if all interactions, all trades in the market have got a buy on one side and a sell on the other, that would kind of seem like a neutral event, right? But if these interactions were neutral, price wouldn't move. And they aren't neutral because the market orders are strong forces and they're trading with limit orders that are weak forces. And that's where something we call liquidity consumption, I don't call it that because I can't say it, comes in. Okay. So the term liquidity confuses a lot of traders. And I think especially because they get it confused with volatility when it's actually the opposite of volatility. So let's just explain what liquidity means before we continue. So liquidity refers to the availability of the other side to trade with. So a liquid market is one that's easy to get into and out of, as there's always someone on the other side to trade with at a decent price when you want to enter or exit. So if we consider our two possible interactions, it's the limit orders, the weak forces that are considered to be the other side. So limit orders are the liquidity. It's as simple as that, right? If you're adding liquidity to the market, you're trading with a limit order, right? So in every trade you take, you're either going to be providing liquidity by placing a limit order, or you're going to be consuming liquidity, taking liquidity with a market order. Okay, and it's a process of consuming liquidity, taking liquidity, that is the key to how price moves. So in this image, we have the strong up force, which is a market buy order, and he's in green. And he's consuming the weak down force, which is the sell limit orders, which we have as the red dots. So the market buyers will consume all liquidity at one price. In fact, they must consume all liquidity at one price before they can move up and consume the liquidity at the next price up. Now you'll notice that there's actually no liquidity beneath them. That's because they've already eaten it. Okay, so on the sell side, liquidity only exists at prices higher than the current price. Now if we look at the other interaction, rather obviously, this is the strong down force consuming the weak up force. So that's sell market orders eating away at buy limit orders. And we have the opposite occurring. So sell market orders consume buy limit orders. And when the buy limit orders have been consumed at a level, price can move down and we'll then eat the limit orders at the next price down, right? There's no buy limit orders above us because we've already eaten them, right? And if we hadn't eaten all the buy limit orders above us, we wouldn't be at this price. Okay, makes sense? I know it's a bit simplistic, but as we progress, you'll see why I'm trying to keep it so simple. So we got strong and weak forces. Strong is the market orders, weak is the limit orders. And we can also consider them to be moving forces and stopping forces. So a moving force, the movement in the market comes from market orders. So like our Pac-Man here, they move through limit orders, consuming them as they go. If there's no market orders, there is no movement, right? There can be no movement without market orders, right? Now the stopping force or stopping volume, limit orders don't really create movement, but they can stop it, right? So sometimes, as in this case, there's just too much liquidity to be eaten, right? So often what we see is limit orders, it doesn't look like there's a lot of liquidity there, but limit orders are actually hidden. And as our Pac-Man approaches a limit order, more contracts get added to those limit orders as we attempt to eat them. And that's something known as an iceberg order. So when the sell market orders can no longer eat the buy side liquidity at a level, price will stop moving down. Not only that, many of those that sold with market orders are now stuck because they sold expecting price to move down. They shorted contracts only to find that price is no longer moving their way. Now, the balance of trade, the volume of buy market orders to sell market orders, is one of the key metrics in order flow analysis, but it's not enough just to analyze these stop in strong moving forces, right? It's not enough just to analyze the balance of trade. These stopping force events are a lot more nuanced than just watching, have I got more buyers than sellers, but they're equally important. So in this image, the buy limit orders have just become a strong stopping force. They've become too big to eat, right? Price will not move down any further. Now, sometimes the stopping force is very evident on your depth of market, on your dome, but much of the time it's hidden, and you only really get to see how much liquidity is truly there by how much eating occurs, how much size trades at that price. So we've got two interactions. We've got buy market orders interacting with sell limit orders, and we've got sell market orders interacting with buy limit orders. It's not that complicated, right? So these interactions, right, are completely independent, right? Now think about that for a second. This interaction here and this interaction here are totally independent, right? But I know what you're thinking. You're thinking, well, these don't move independently, right? So we know if price moves up, then this moves up as well, right? So if we start moving up here on the depth of market, if the offers start moving up because the buyers eat it, we know the bids will move up as well. But they are still independent. The thing is, we've obviously got a missing piece. There's obviously a missing part of this puzzle. Now, the term inside bid here and inside offer simply refer to the bid and the offer prices that have to be eaten next. So it's the highest bid and the lowest offer, or the best bid and the best offer, right? Now, the difference between the inside bid and the inside offer, which is usually just one price, is known as the spread. There's a lot of people here thinking it's very, very basic, but it's worth going through this. You all know this, right? So as you can see on this dome, the inside bid and the inside offer are just one price apart, which changes market to market. But what doesn't change is they're kind of glued together, right? You don't see the offers, for instance, moving up 50 ticks while the bids move down 50 ticks, right? We don't see that, but do we stop to think about why? So what is the missing piece? You know, if these two interactions here are actually a true representation of what happens in the market, why don't we see the distance between bids and offers increase and increase and increase as trade continues? Why don't we see the spread widening massively? Think about it. You know, we've discussed two interactions with no relationship between them. Okay, so either I'm wrong about the interactions or there's something missing. So we take for granted that the bids and offers tend to move up and down together, but they're not related at all. The interaction up is independent of the interaction down. So what are we missing? Why do we not see the up and down forces moving the two sides of the market further and further apart? Okay, so if the spread gets wider, here's what happens in the market. It creates an opportunity for traders to play in the middle, to play the spread. So if you had a 20-tick spread on crude, you could, for example, let's say the offer was 55.50 and 55.30, right? You could step in the middle of that, and you could bid 55.31 and offer 55.49. You'd stand to get an 18-tick profit for nothing if your orders got filled. Okay, and that's where these guys called the deplorables come in. Okay, so with a 20-tick spread, you stand to make a 20-tick profit just playing that spread. But the problem is somebody else is probably willing to jump in and take an 18-tick profit. And then somebody else says, well, I'll have a 16-tick profit. It's all free money, right? So all they'd have to do is put in a slightly higher bid and a slightly lower offer, and now they're at the front of the queue. They get the next market orders. Yeah, but the problem is now the spread's narrower. Now, during the days of the trading floors, this process of jumping in on the spread was known as diming the market, because the intervals between prices were a dime, right? So if the spread was 2 ticks, somebody could dime the market and jump to the front on one side, you know, knowing the spread to 1 tick. And in some markets, I mean, I don't know if you ever, any of you have managed ever went to the trading floor. They've got a line outside the building where if you have a fight, it has to be outside that line. And if you have a fight inside the building or within that line, then you get fined by the CME, right? So it's a very testosterone-driven environment. So, you know, if you were repeatedly diming a market, then you probably would end up downstairs past the no fighting line outside the CME building, being re-educated by your fellow traders about the wisdom of your actions. So we don't really see that now, obviously. In most electronic markets, the spread rarely widens for long before somebody jumps in and fills the gap. So whoever jumps in just got first place in the queue and is going to be filled against the next market order that comes in. Now, if you want to try this yourself, pull up an options market on your screens, an option market that's got wide spreads and really low activity, you know, so, you know, maybe a 20 or 30 tick spread. You put a buy order in front of the bid on that option, and within seconds, somebody else will jump in front of you, right? No doubt cursing you at the same time. Your chances of getting filled are really small. But basically, there's just algorithms there that stay at the front of the queue, right? Now, what's the effect though when that spread narrow? When people jump in there, what's the actual impact of that? So let's say the inside bid is 55.50. And the offer's 55, right? So we know the next market sell order is going to eat the bids at 55.50. So if somebody comes in, narrows the spread, and they bid 55.51. Now the market orders have to eat the bids at 55.51 before they can get back to 55.50. That's one price higher. So the offer side hasn't moved, but the bid moved at 1 tick, closing the gap. And the bids can continue to rise until they reach 1 tick below the lowest offer, and that's as high as the bids can go. So if you try and put a bid in above the offers, it just turns into a market order. So this process of diming can move the markets back together, but it can't move them apart. So it's like a magnet between the bids and the offers. So the upshot is that while we do absolutely have two very independent interactions, one up and one down, the filling of this spread here by the deplorables, that's the glue that stops these two interactions just moving further and further apart. Okay, so we have the up interaction and we have a down interaction. We have the deplorables filling any gap between them, gluing them together and making it a sort of tug of war. But it's a tug of war where there's also potentially a stopping force that could pop up at any moment. So in this case, we can see a tug of war between buy market orders here and sell market orders here. And a few ticks up, we can see a massive limit order, right? Now, if that limit order is real, in other words, if they don't pull out of the way when we get there, it just might be too much for the buy market orders to consume that limit orders. They might not be able to eat to all that liquidity. So the balance of trade, as I said, is a part of the picture, but all other things equal, the side with the most market orders will see any market move their way. But a lot of the time, that's all you see going on. So on the S&P, for instance, it's usually 1.5 to 2 times on the dominant side in terms of market orders. So you might see the majority side, for example, being buy market orders for hours and the market moving up. Later on, you see the balance change to the sell side and the market moving down. Other times, this stopping force will be in effect. So it might be visible with the bids and offers displayed, or it might be invisible as an iceberg order, and it might be fake, in which case it just pops like a balloon when price approaches. So in this case, we'll consider this real and that's a huge amount of sellers. The price isn't going to move up anywhere. Okay, so the stopping force, where do you really see it, right? So obviously you can see the limit orders up there on the dome, but the place you really see it is in the number of contracts that trade at each price, right? So for example, it may take an average of 300 contracts to eat through each price on the way up, but then suddenly it's taking 500 contracts to move up, then 2,000 contracts to move up, 3,000 contracts to move up. That's the stopping force getting stronger and stronger. Okay, so often if you look at the winner, right, a lot of the time the winner or the direction is set by where the balance of trade is. So if there's twice as many market orders on the buy side as the sell side, that's the way market's going to go. But then there are other times when the limit orders become a stopping force, the market just can't eat through them, right? So when you're looking at moves in the market, and it's always a dance and a combination of those, but when you're looking at those moves in the market, you're always looking at how much you're trading, but we're also looking at when an exceptional amount trades because the stopping force gets strong, people just get stuck, and then the market turns around. Now, a couple of other things we need to understand. So here we have the Jigsaw dome, and this is showing 10 levels of depth. What's really important to understand is that there is buyer liquidity, okay, below us, right? There's buyer liquidity all the way down here. You see 10 levels, but there's buy liquidity way, way, way below us. But we just can't see it because with many markets, that's all the data feed gives us. But there is no buy side liquidity above the current price. Really, really important. Now, on the sell side, there's seller liquidity above us. But again, you can't see it. It's going up hundreds and hundreds of prices, but we just don't get on the feed. And you don't need it on the feed, right? If you know, the day you need 100 prices on your dome is the day you should stop trading, okay? But there is no, below us, there is no sell side liquidity below the current price. And this is important. It means as we move up, we're actually moving up into areas where no liquidity exists, no buy side liquidity exists, okay? So when we move down, we're actually moving down into areas where no sell side liquidity exists. So that means in a move up, right, we get a relative liquidity vacuum behind us. It takes time for these bids, for these limit orders to build up behind a move, right? In a move down, you get a liquidity vacuum created above. It simply takes time for that liquidity to build up again in the wake of a move down. And spotting these liquidity vacuums where price pulls back because of a lack of liquidity and not because of counter trend trading is one of the opportunities that order flow gives you. This is one of the ways you get to trade pullbacks. And this is another way to imagine the liquidity picture. Bids getting thinner as we move up and offers getting thinner as we move down, right? And that brings us to another really, really important point when you are reading order flow. And that is at any area of resistance, right? So you're going back to the high of the day, you're going back to the low of the day, right? At any area of resistance, the liquidity outside the area, so the liquidity directly above the high of the day will be 1.5 to 3 times what the bids are. It will be exceptional. When you go back down to the low of the day, the liquidity on the bid side below the low of the day, immediately below it, one tick below, will be 1.5, 3 times normal liquidity, right? In fact, if you're not sure whether a level that you're looking at is one that other traders see as resistance, that's going to tell you in itself. It will tell you other traders are looking at that area, right? So as you get to resistance, you will see big bids. The thing is though, it does not mean the level will hold, right? It's the same at lows with support. The bids are stacked at any valid support level, but it doesn't mean the level will hold. It's just the way the market works. It's like a quirk of the market. It's fake liquidity. Most of the time, they're going to get out of the way, right? So very often as price trades up towards these thick areas, they just pull out of the way and price goes straight through. Now, let's just take a step back and think about what does this theory actually mean. So we've gone through a few theoretical things. I mean, it's not theoretical in that it's not true. It's just a different way to look at the market, right? So it's not a theory as such. It's just not practical application, right? So we can't cover all aspects of order flow today, but we can get you to wrap your head around the kind of things that order flow will give you and the kind of thought process of an order flow trader. Okay, so we'll do that first of all by looking at a couple of things that continually catch out novice traders. So the first one is spikes and churn. So a spike or a fast one-way move in the market tends to fool people that move is going to go on forever, right? So people see it, they fear they're missing out, the market's moving, oh my God, it's going up more, I'm not on board, oh my God, it's going up more, it's going to literally reach the sky, and then you buy it, and what happens next? Market rolls over, and you've just bought the high of the day, right? We've done that loads of time, and we'll see an example. We've all done it, right? But if you think about it, right, and if you think about the liquidity vacuum behind us, the faster the move, the more of a liquidity vacuum builds behind you. It's like a speedboat has got a bigger wake, right? The faster it goes, right? So there's very little time as you move up rapidly for bids and even positions to build up behind you. So when you see a really fast move, that's more indicative of weakness in the market or future weakness because there's nothing holding that price in place. Now, the other thing that catches traders out is a slow grinding move, right? So when you see these days, you know, you often get to the end of a grindy day and you're looking back and your friend's calling you, oh man, the market went up today, you must have made a ton of money, and you say, I didn't get in, right? You often scratch your head at the end of the day wondering, how on earth did I miss that, right? You know, how did you manage to not get on board? And the reason is slow moves look weak, but in a slow move, you don't get that liquidity building. The liquidity building has plenty of time to build up behind the move, and you get lots of positions there too. Instead of trading 50 contracts a price, you're trading 500 contracts a price. So the move up has got a lot more structure supporting it, okay? So just think about the way you consider both things and how much better off you'd be if you flip your strategy around on them. Now, retracements, reversals are always a little bit tricky. The key thing with a retracement is whether the counter trend move is a retracement and not a reversal, right? How do you know? Well, with order flow, it's relatively simple, and I'm saying relatively compared to just looking at a price chart. It's simply the amount of participation in the counter trend move. Right? So if there's not much trade in the counter trend move, if there's not much interest in the counter trend move, if the market's sluggish, if the balance of trade is quite even, then that counter trend move is more about the market just temporarily falling back due to a lack of liquidity. And you know, what happens is very simple, that market makers don't bid heavily every price, right? So if the market's moving up, the market makers are going to trail their real intended trade, the majority of their intended trade, 4 or 5 ticks behind the market, 10 ticks in the market, just depends on the volatility. And you know, if a market's moving up and you want to jump on mid-move, you don't get with a market order. It's, you know, just wait a bit lower down. So, you know, when a market is moving in a counter trend move, people aren't just going to straight, you know, bid because it's ticked 1 tick back. Right, they'll let the market tick back, but it won't come back because of overwhelming selling. So if the market's in an uptrend, you'll have lackluster trading, right? Lackluster selling, right? So think about that again. It's the volume of trade, it's the balance of trade in a retracement that tells you, is this a retracement or is it a reversal? Now, on the topic of reversals, you can basically boil down any reversal in any market just down to 3 activities. And this is where people start to think I'm smoking funny cigarettes, but I'm dead serious. There are 3 elements of reversal, and only these 3 things can turn a market, but they're not exclusive, and you'll often see one and then the other. So the first is absorption, and often that's called an iceberg order. And what happens there is buyers continue to buy at the market on the way up, but the offers, the sell limit orders absorb the buying. With this, you can see a large amount of buying and no move up. The buyers are stuck. And at some point, they give up, or at some point, one side gives up. And of course, there are things you can do to help you figure out which side that will be, but we'll leave that for another day. The second element of reversal is buyers fading away in an up move. and you can reverse that for the opposite direction. So what happens is you reach a price, a few contracts trade there, market ticks back down, goes back up to that price, again, a handful of contracts trades, and depending on this market, that can happen over one price or a few, but it's very clear. You suddenly see there's just no interest from the buyers anymore. And the final element of reversal is where the other side comes in, and this is where a market finally rolls over. So sometimes you see an up move and the sellers have already seen the absorption, they've seen there's no buyer interest, and they just want to nudge the market against the stuck or late buyers, and sometimes they're coming from nowhere, right? Sometimes there's no absorption, there's no buyer fade before sellers come in, they're coming from nowhere. And these three elements of reversal are there for every reversal, but not all of them. It's usually a combination, and they're all things you can read in the order flow, and some things are easier to read than others, and each reversal, like I say, will contain one or more of them. So if you take one thing home today, make it that. Now, we haven't got time to go over all the aspects of order flow, so let's just walk through one example. Okay, let me just take you through one example because we are kind of running short on time. Just walk you through one chart. This is the gold futures, and this is yesterday, right? So the chart here we're looking at is the Auction Vista chart, and the grey background is showing us basically limit orders. Those are the weak stopping force, and we can see at point A here, the area is much lighter, which means the offers or that stopping force at this level is much bigger, much larger than anywhere else. And what we can see here going on is really typical, right? So we've got this light area here. As price approaches, you see it becomes darker, they just pull out of the way. Now, as you study order flow and you look at websites, you're going to see people telling you that this weak stopping force, these limit orders, are much more significant than they actually are. But think of it like a game of poker, right? You can add more limit orders when the market gets to your price. You don't have to put them in ahead of time. You can actually program them to hit the at the actual exchange, right? So the exchanges allow you to place hidden order types that do exactly that. They hide you until price gets there. In this case, traders decided to display their orders and not hide them. But why? Well, simply because they had no intention of letting those orders get hit. And that's something called spoofing. Now you can say, but isn't that illegal? It's not really illegal to spoof. It's spoofing and doing something on the other side that's illegal, but you can only get caught if you're really, really small. So when you see people out there telling you to sell, when you see big sell limit orders, test it first, because it is a net losing strategy. Poker players don't show their hand, and neither do traders. Anyway, let's look at point D, right? The weak selling force, right? So again, we can see that traders put in some big limit orders for everybody to see right there after we hit the high and start to go down. But look at point F, right? The moment the price got close, they got out of the way. Fake trades, very sad. Right, now point B, we can see a big spike up. This is where it's really interesting, right? So what we can see here, a big spike in price, and we can see here at point C, that tells the volume is very high, right? It also shows by the blue and red, the majority of the trade is buying, right? No surprise there, we just talked about imbalance, right? So what's happening here is a high volume spike, right? Something very common and something you've no doubt been victim to yourself, right? So the market, market moves one way, you feel like you're missing out, you can't wait anymore, and you get into the market and suddenly that's the high of the day, right? Now at point B, we have this circle. Now these circles are unique to Jigsaw, and they show where an exceptional amount of trade occurred. So at the top, this is where a bunch of traders got caught offside, and it's their stops that help the market move down so violently after we get there, right? And of course, what's helping as well is the vacuum caused by the move up. Now these circles print in real time, it's not after the event. Point A, we can see another high volume spike, trap traders just on the other side. You can see point F, very similar thing, market reverts to range. We can see that a lot of these turns in the markets are defined by high volume at the extreme. Okay, now that in itself is just one aspect of reading order flow. All of these extremes, traders were trapped, right? Those are things you can add to your trading fairly easily and start making improvements fairly quickly, right? Now, understanding the mechanics of price movement is just the first step of starting to benefit from order flow. And order flow is one of those few areas in trading where you actually get rewarded for your efforts. So proprietary trading firms have their traders trading exclusively off order flow with no charts, because it's the fastest way they know to get there in terms of profit, right? And I know that sounds crazy. Everybody thinks it's crazy to trade without charts, but that is what new professional traders do. And I know professional traders that still do it right now, and I'm talking about traders that make 6 figures a week, right? So to get you there, to help you get from where you are now to where you want to be, what we do, we have a combination of education material, much of it free. We have an institutional grade trading platform, and we also have a cloud-based trade analytics system to help you analyze your performance so that you know what's making money and what isn't. And then finally, we've got a community of traders that meet daily in our free customer chat room. And not only that, we obviously make ourselves available for one-on-one sessions with our customers. We don't charge for this, but we actually make ourselves available on Skype to talk to customers all the time, right? It's just part of what keeps us in touch with the market. So for those who are really interested in making improvements to your trading, for those that have seen some aspect of the market they haven't thought about today, that feel, you know, there's something there that's actually hidden from them that they can't take advantage of, just go and Google us and read the reviews, right? You don't have to take my word for this. Look at the reviews, there's forum posts. You can see it's very obvious this isn't stuff we've written ourselves. From our customers, you can find they're plentiful and overwhelmingly positive, right? Because basically, we really do help people. Now, for those who are interested, we do have 2 main options. Both options include the trading platform, the chat room, the analytics. The first is for people that have a method they want to refine, which is the lifetime license with 10 hours of order flow education. The second is the institutional package. And in this package, we actually have a training course that's from a prop firm in London. That's our partner in London. That's a real bricks and mortar trading firm where they have 6-figure traders. Now, when I say 6-figure traders, I mean 6 figures a week. Right? In that course, it teaches 19 setups and the conditions they work best in, as well as various drills and exercises to make the information stick. So basically, if you're interested in, if you're nearly there, looking to improve, you need the first package. If you're looking for a fresh start, you feel that you've got really nothing at all that will work, then it's the institutional package. And you can get $50 off the first one and $100 off the second one with the coupon codes Traders Talk 50 and Traders Talk 100. If you just go to jigsawtrading.com/Traders Talk, you'll see the links there. What I'd like to do, I would like to thank you very much. I don't have time to answer the questions, but if you want to Skype me, my Skype ID is Jigsaw Trading, and that is all one word. And with that, I will hand you back. So thank you for listening.